This week, I'd like to have a discussion about the efficient markets hypothesis and the incorporation of new information. Now, I want to say to begin that this is something that I've been struggling with for years because I have long been a proponent of EMH. I believe markets are fundamentally very efficient, and I believe that it's pretty much impossible for anybody to reliably pick stocks in a way that beats the market. So that's the way things work when it comes to individual security selection. My concern, however, is something that I've been discussing with my wife as she asks me to explain things that are going on that I have to confess I cannot reliably explain. And that is that there is a very strong consensus about what the war in Iran means for capital markets. So let's see if we can take a moment to walk through this. And again, I want to use the preamble. I don't know what the great solution is here. I just want to get people thinking about a problem that has been vexing me for some time to see if anybody could offer any kind of an insight that I can't come up with. The efficient market hypothesis says that markets reflect all available information reliably and accurately and quickly, so that whenever something new happens that should have an impact on what markets do, it should be reflected almost instantaneously. So as an example, last April, the American President Donald Trump initiated something that he called Liberation Day, and he imposed tariffs all across the Western world. And lo and behold, as soon as it was announced, stocks dropped, and they dropped for about 3 days. And then just as quickly, he announced that they were being put on pause and they would be reduced and so on and so forth, and markets went back up. Now, there's a clear cause and effect of markets going down when the tariffs were announced and going back up as a result. So that's efficiency, right? Well, maybe, but not so fast. Everyone knew that Trump would be initiating these tariffs way before he actually did the press conference. So everyone should have known that tariffs were coming. The exact order of magnitude, the terms and conditions, those sorts of things were not known. But we certainly did know that tariffs were coming. And as a result, you would have expected, one might reasonably expect, maybe I should say, that capital markets should have reflected that change in policy before it was formally announced, because everyone knew it was coming anyway. It was just the details, the fine print, if you will, that people didn't know. Well, here we are now in May of 2026, and it's a new situation. We're in a war in the Middle East that has been going on now for over 2 months. Strait of Hormuz remains blocked, and we have a situation right now where many people, I'm thinking of someone like, say, Robert Pape over at the University of Chicago, a geopolitical expert, has said that the U.S. has entered into an escalation trap where they're in a war that they can't reasonably get out of. And despite that, it continues and markets are hitting new all-time highs. And despite that, we're in a situation where people are saying that even if the war ended today, markets would have a tough time recovering because there's enough inflation baked in because of what's happened with the supply chains being disrupted for oil and for fertilizer and whatnot, that there will be inflationary pressure that will last probably until the end of 2026, even if the war ended now. But the thing is, the war isn't ending now. If anything, it's becoming more acute, and yet markets are hitting new all-time highs. So my question to you is, how does that square with the concept of market efficiency? People would argue that, well, if something new happens and the market reacts based on maybe the bonds dropping or something else, and that causes markets to drop or not, then that would be something new that would be incorporated into the prices of securities, and that would show that markets are efficient. My rejoinder and my question to you is, except that everyone has known for months that this is a war that is going to be going on for a long time. Everyone has known for months that supply chains have been disrupted and that will be inflationary and difficult for the economy to react to in any kind of a positive manner. So how can we explain markets hitting all-time highs in May of 2026 when we are already in a war that is 2 months old and has no end in sight and is almost certain to be inflationary and disruptive? I don't know the answer, but I'm wondering if anybody who is an efficient market hypothesis proponent, which, again, to repeat, I have been for pretty much my entire professional lifetime, if they could explain that to me, because I am at a loss.
If you're worried about the current investment climate and your money,
go to my website to book a call for personalized advice to assist you in feeling secure and protected about your retirement.